gold, silver should go back to 15. Okay. It's only mined at 8-1.
Right.
It's in the Earth's crust at like 10 or 11-1. Why the hell should it have traded at 100-1? And it's already down at what, 67, 68-1? I think it's going right to 15, 1 to 15. Okay. So let's say if the gold price is 4,500, which is near, makes the calculation easy. Silver should be at $300. That's where it should be. That's without a physical shortage. Okay. Now we throw the physical shortage on top and the shortage of silver stocks to buy. I mean, the runway is so wide open that I can see nothing but clear sailing for silver.
For much of the past decade, silver has been the forgotten metal. While gold steadily rebuilt investor confidence after repeated crises, silver spent years failing to regain its former highs, repeatedly stalling below the $50 level and frustrating even long-term believers. That dynamic has now changed in a way that is difficult to ignore. Silver is no longer inching forward cautiously. It is accelerating, printing new highs with growing frequency, and doing so against a backdrop of tightening supply, rising industrial demand, and a market structure that looks increasingly fragile. At the center of this renewed momentum is a growing focus on the gold-silver ratio, a relationship that has historically acted as a powerful signal for major silver moves. Today, that ratio is falling fast, and according to Eric Sprott, it has much further to go. Sprott argues that silver's true value has been distorted for decades, pushed far below where geology, mining realities, and real-world demand would naturally place it. His view is simple but bold. The gold-silver ratio is not stabilizing at current levels, but collapsing toward 15-1, or possibly even lower. Eric Sprott is not making this case from theory alone. He points to the physical realities beneath the market, where silver is now mined at ratios closer to 8-1 relative to gold, and where the metal's natural abundance in the Earth's crust is steadily declining. This matters because silver is not just money. It is a consumable industrial metal. Every year, more silver is used up in electronics, solar panels, and emerging technologies than is economically recoverable at current prices. That imbalance, Sprott argues, is no longer sustainable. This is why his projection is so striking. If gold were to trade near $4,500, a level many investors already consider plausible, a return to a 15-1 ratio would place silver near $300 an ounce, even before accounting for physical shortages. In Sprott's view, the recent breakout above silver's prior all-time high is not the end of the move, but the beginning of a far more aggressive phase, driven by forces that paper markets can no longer suppress. Before we go further, make sure you're subscribed to the channel and have notifications turned on. In this interview, Eric also discusses why bullion banks may have lost control of the silver market, how physical deliveries are overwhelming paper supply, why major institutions are quietly changing their allocation models, and how new industrial uses for silver could permanently reset its price floor. Let's get into it.
When I think of gold and silver, I think that when gold in 2024 broke through 2,000 for the third or fourth time, I forget which it was, I think they lost control of the gold market. And when I say they, I'm referring to the banks that were forever short. You get the data every week, big short position. Who owns it? Well, it's mostly the commercials, which are the banks. And they're always, the only shorter there was the banks. Imagine if the banks weren't short. Where the hell would the price of gold be? And then I think they finally realized, okay, look, we can't hold this thing back. So that next thing you know, gold goes from 2,000 to 4,000. Now, I think the same thing happened in silver. I don't know what the magic number was, whether it was 35 or 40 or some number like that. And of course, they've lost control of it. And I think everybody knows they've lost control of it. When you watch the day-to-day data of silver, you know that they can't possibly supply the demand. But we've known that for 5 years, but because they had inventories to work with, they were able to supply, and of course with the paper supply that they had, they were able to meet that physical demand through the inventories and were able to meet the demand in the COMEX through paper shorting. And I think now they realize, okay, well, that's game's over because now we can't supply the physical anymore. We know that. You look at the stress points that we've had at the LBMA and the COMEX and the demand like some of the demand statistics that we can look at during the year. The latest one being in October, when India about 55 million ounces of silver in a month. 55.
Right.
I always annualize these things. That's
Right.
660 million ounces. If you did it every month, we only mine 800. How can a country buy 55?
Yeah.
You'd think it was literally impossible. And we have the same sort of thing going on in the COMEX, where maybe this month we'll do between 50 and 60 million ounces of deliveries in a month. Well, now I know it doesn't happen every month, but geez, if it was for 12 months, it'd essentially take all the mine supply, give or take 10%. So you see these huge demands. And of course, we also have retail people buying it in large quantities too. There's a tech guy, the David, someone, I forget his Blackwood.
Bateman.
Bateman, that's
right?
it.
Yeah.
And he's buying millions of ounces of silver. And, you know, guys like you and I might buy a lot too, and recommend a lot of people buy it. And, you know, we haven't left. We're still there to participate and recommend it to people. And of course, we have that audience now. And we have a new audience when the gentleman at Morgan Stanley suggested the new model portfolio 60-20-20, with 20 being precious metals.
Right.
Whoa, my God.
Right.
Blow the lid off. I mean, that just blows the lid off. Can you imagine if they really wanted to go to 20, where the prices of gold and silver would have to be? We wouldn't even recognize the number. You know, like it could be like $1,000 for silver to get to 20% silver.
Yeah.
And who knows what for gold? I don't know what the number would be, but it'd be multiples of 10,000 for sure. And then you have other people's, just imagine trying to get from 1% to 2%. We only produce 1% more gold in a year. Okay. So fine. You go from 1 to 101. How do you go from 1 to 2? The price has to change. The price of the underlying thing, the price of the commodity, the price of the shares. That's the only way that can go up. And then we're going to have in 26 sort of a crowding out thing that I'm sure happening now. I saw my first reporting on it recently when someone was talking about the strength of the Canadian dollar. Why is the Canadian dollar strong? It's because of gold and silver. Because if you want to buy gold and silver stocks, where do you go, my friend?
Where do you go? That's true.
Where do you go? Where does the world go? And if the world's buying gold and silver stocks and the weighting of the stocks keep going up in the indices and you're a Canadian institution, how do you keep your weighting up when the shares are going offshore all the time? You can't. It's what I call the Nortel effect, where Nortel got to 30% of the index because everyone in the world was buying Nortel. And a Canadian institution, we can't own 30% if the world owns 30%. You know what I mean?
Right.
So we're going to have that effect here, where everyone buying these stocks, a lot of them have to come to Canada to buy them. And it strengthens the dollar remarkably. And of course, it gives a floor to the valuation of the stock. And then, of course, it's going to give a lift to the valuation of the stocks if, in fact, the institutional clients get on board. And you sort of sense that it's happening. We see it in the underwritings that take place. Who's buying them? Why are they buying them? How big are they buying them? And believe me, they're buying them way bigger than they were a year ago. They wouldn't even be buying them a year ago. Now some guy comes and wants 50 million of this issue, right? Out of nowhere. One institution.
Right.
So it's happening.
What's your allocation as we head to next year?
Well, I would have said, like if it was last year, I probably would have said I'm 40-60 silver gold. And I don't even look at it that way, like I haven't done the calculation, but I know I got to be 50-50, and maybe I'm even going 60-40 here, 60% silver, 40% gold.
Yeah.
And in the market of shares, recently I have very, very much focused on buying silver shares to the detriment of gold. And I find it so ironic that a broker would phone me up with a great gold idea, and I said, nah, I can't buy that. Well, why not? It's gold. And then, what? You're not buying it because it's gold? And I said that. I said, I want to buy silver, which is the whole story.
Eric Sprott on the phone.
Which is the whole story we'll have to talk about, okay? Because that is the story. So and now in my portfolio, I'm really leaning in on silver stocks, and I hope my silver stocks go through more than 50-50. They're very tough to buy, right? There's only like 13 major
Yeah.
silver mining stocks. And most of the silver mining stocks aren't even primarily silver miners.
Right. Right.
So,
You've talked about that for as long as I've known you.
yeah, which again tells you the problem with silver, the physical supply of silver. Just because the silver price goes up doesn't mean a copper miner is going to increase his copper production. Or lead zinc guy is going to increase his lead zinc production, which then causes silver production to go up. So we have a hell of a fine macro setup here for silver to explode. And I may as well go there now. I've always been a great proponent and believer in Michael Oliver's work, who does this momentum structural analysis. You've interviewed him, I'm sure.
Yeah. Oh, he's a great guy.
And that guy's been as right as rain.
As the discussion unfolds, Eric Sprott's argument becomes more structural than speculative. He describes a market where years of heavy paper shorting masked a growing physical imbalance, allowing banks to meet demand with inventories and derivatives rather than metal. That strategy, he believes, has now reached its limit. With inventories depleted and physical deliveries accelerating, price suppression no longer works the way it once did. The result is a market that reacts sharply to demand because there is simply less real silver available to absorb it. This is where Sprott brings in the work of Michael Oliver, an analyst widely respected for his momentum-based, structural approach to markets. Oliver's analysis focuses less on narratives and more on price behavior itself, identifying moments when long-term resistance gives way to sustained upside momentum. In silver's case, Oliver has argued that once key levels were cleared, the metal would not grind higher slowly, but move rapidly as capital is forced to reprice scarcity. Sprott sees this confirmation as critical because it aligns technical momentum with physical supply stress, a combination that historically leads to outsized price moves. With that framework in place, Eric turns to the deeper implications of what happens when a market transitions from managed to uncontrolled, and why silver may now be entering that exact phase.
I go at it from the point of view that I've always believed that silver was manipulated big time for 50 years, okay? And I don't need to justify, 10 or 12 major banks have been short the whole market for that whole time.
Yeah.
Why are those banks short the silver market, okay?
Yeah.
Is there a reason for that?
They're hedging.
They're not hedging. We know that. Nobody hedges anymore. There was an excuse 20 years ago. So I can believe that it's gold silver should go back to 15. Okay. It's only mined at 8-1.
Right.
It's in the Earth's crust at like 10 or 11-1. Why the hell should it have traded at 100-1? And it's already down at what, 67, 68-1? I think it's going right to 15, 1-15. Okay. So let's say if the gold price is 4,500, which is near, makes the calculation easy. Silver should be at $300. That's where it should be. That's without a physical shortage. Okay. Now we throw the physical shortage on top and the shortage of silver stocks to buy. I mean, the runway is so wide open that, I can see nothing but clear sailing for silver. It might have times when it gets beat up. And I always find it hilarious watching silver trade on the COMEX. And, they have these 10-minute bursts to the downside.
Yeah.
Bang, 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 bang.
Yeah.
And a half an hour later, it's right back up there.
Mm-hmm.
What is that guy trying to do? Is he setting off stops or something? Or I don't know what they're doing.
Yeah.
But they never win that thing anymore when they're banging it down. They don't win those things. They lose every damn battle. We have done so differently this time. And of course, any student of silver realizes what's happening here when you see the nomination for deliveries almost every day on the COMEX, physical delivery, new. Like I think yesterday overnight, there's probably something like 70,000 new ounces demanded. That's 70 minutes, $200 million, $200 million in a day. Some guy comes in and buys 200 million of physical silver on the COMEX. I don't know what happened in the LBMA because you never seem to know what's going on over there. And of course, we got the Shanghai exchange. And of course, silver went up 5% 2 days ago, went up 1% overnight tonight. It's been a very important market. We took their inventories from like a million kilograms down to 500,000 kilograms. It's inched back up here to, I don't know whether the number is 700,000 or 800,000, but I noticed it went down yesterday. But, the Chinese, and this is a point, have said that as of Jan 1st, we're not exporting any silver.
Right.
Unless you get a permit. And they were big exporters, okay?
Right.
So that could be 50 or 100 million ounces. It's not coming out of the market.
That I've got to jump in and segue in another question here, because that was another one that we got. How much do you think China, Shanghai, is now the price maker versus, where it always had been the paper markets of London and New York? Is now China the overnight trade that starts currently at 8 o'clock Eastern every night?
Yeah.
Is that the market? And then London, New York is just reacting to that now.
Well, there's no doubt that, as you know, both London and New York, until a few years ago, hardly ever had a delivery. What's a delivery? They never delivered anything.
No.
Okay. COMEX and the LBMA didn't have deliveries.
Yeah.
Well, of course, Shanghai's always been, it's a delivery market.
Mm-hmm.
And of course, they're the largest provider of silver, and they're the largest consumer of silver, although the Indians are giving them a run for their money, okay? So, that's going to be the nexus of where things will be determined in the future, for sure. And they're the biggest users of silver. When it comes to like solid state batteries, it's all Chinese dominated. I know your president's trying to get some plants built over here. We'll see whether that works or not. But I mean, they have the facilities already. So they are going to determine the price. Asia will determine the price.
What's a risk to price at this point? Is it a stock market crash? I mean, what risks are there?
Well, I think that would be a big risk. Although when I listen to Michael Oliver, who's a student of markets, he's more of a student of markets than I am. And he points out that in a number of those markets where it went down, it went right back up again. Some that hardly even went down, but it always went right back up again. And we've had a time, we had a lull in the mining stocks here. I think it was in October, came right back up again, right? So I think that the fact that people realize you got to shift from paper to physical, that will provide a real buttress for the gold and silver if the market starts fading. So even yesterday when the market got beat up pretty good, gold and silver did okay. Silver was way down and came up, and gold went up. Today we've got the markets doing very well. And of course, now gold's starting to run here. Silver, which was down, is almost back to break even. So I think that people will see through this and hold in there, because, if they're trying to go from 1% to 2%, that's a lot of buying.
Right.
I like to think that maybe I already own 0.1 of 1%. I don't, by the way.
They're going to come for yours.
And you ain't getting it.
Are we still getting the naked predatory short selling? Are we at a point yet where that has begun to dry up?
I think there's still short selling and naked short selling going on in the junior miners, because it's easy to do it. How do I know that? I own lots of junior miners. I look and see what the stocks do at the close, and they get forever. Some guy comes in and knocks it down in the last 5 minutes.
Yeah.
Like, what are we doing here?
Yeah.
Like, why always at the close? Okay. And I'm sure it's predatory selling. And particularly when you see something going down quickly, which we see a lot in the commodity trading, right? There's not a time when gold goes down slowly. When it goes down fast. Or silver goes down fast. Now they'll move it down $2 in a day. The first $2 move on silver, I saw, was to the downside, not the upside. I got to mention the solid state batteries, okay?
Oh, what? Okay.
And I think that this solid state battery is going to be so dynamic for the price of silver, and we haven't even seen 1% of the impact in silver yet. Well, Samsung develops a battery that charges in 9 minutes. Can anybody figure out why that's a good thing?
Right.
It goes 900 kilometers. Can anyone figure out why that's a world change? And they use a kilogram of silver in this solid state battery. By the way, they use manganese too, which I'm a big owner of. Not the metal, but the companies. They say if that could capture 20% of the electric vehicle market, it would consume all the silver produced in a year.
My goodness gracious.
Yeah.
And that's just that. That's just that battery. That's not solar panels and electronics.
Is it any wonder that these Asian countries keep buying these materials?
Right.
So I think that's a big, big change that's coming. And they're going to be starting to produce these things, I think, for consumption in 28 vehicles. So that's 27 production, which means maybe buying the metal in 26 to make sure you got enough. And, was there a shortage? Yes, there is. Well, you're screwed already. Okay.
Mm-hmm.
So you better find a way, Mr. Samsung.
One of the most important themes Eric Sprott raises is manipulation, not as a conspiracy, but as a long-running market structure. For decades, a small number of large banks maintained massive short positions in silver, positions that could only exist because physical delivery was rarely demanded. That environment is changing. Silver is now being called for delivery on a scale that exposes the limits of paper supply, and short-term price smashes no longer hold. Prices dip briefly, recover quickly, and continue higher, suggesting that sellers are losing the ability to control direction. At the same time, global demand is becoming more concentrated in regions that insist on real metal. Asia, particularly China, operates delivery-based exchanges and dominates both production and consumption of silver. Export restrictions, combined with rising domestic demand, reduce the amount of silver available to the rest of the world. When pricing power shifts toward markets that require physical settlement, paper pricing mechanisms in London and New York become reactive rather than decisive. Industrial demand adds another powerful layer to this story. Technologies such as solid-state batteries are not theoretical concepts. They are moving toward commercial production. These batteries require large amounts of silver and offer performance advantages that could reshape the electric vehicle market. Even modest adoption rates would consume a significant portion of annual silver supply. Unlike investment demand, this silver is not recycled quickly. Once it enters industrial use, it is effectively removed from the market. For investors, this creates a rare setup where monetary demand, industrial consumption, and declining geological supply are all pointing in the same direction. Silver is not rising because of speculation alone. It is rising because the market is being forced to recognize limits that were ignored for years. As Eric Sprott emphasizes, prices do not adjust gradually in these environments. They adjust violently because price is the only tool left to ration scarce supply. The broader implication is that silver's role is changing. It is no longer just a leveraged version of gold, but a strategic metal with growing importance to energy systems, technology, and national supply chains. In that context, a return to historically low gold-silver ratios is not extreme, it is logical. What once seemed unrealistic now looks increasingly conservative. If you found this analysis helpful, please like the video, subscribe to the channel, and share it with anyone trying to understand what is really driving the silver market today. Thanks for watching, and I'll see you in the next video.